Market corrections, well, they always feel like the end of the world in the moment. But if history tells us anything, it's this: fear fades faster than fundamentals. All right, welcome to the Wealthologist Friday Focus. I am Chris Hobart, the Wealthologist. Now, I want to talk with you about this recent market correction we've been dealing with because the question on everybody's mind seems to be, is this time different? Well, here's my take on it. Not really. You see, like most corrections, it began with legitimate concerns. Now, in this case, it's about future economic prospects and geopolitical tensions. And like most corrections, those fears fed on themselves until the market priced in far more panic than was probably warranted. Now, got to tell you, this pattern, it's not new. What typically happens next? Well, we get new information, expectations shift, and investor sentiment begins to recover. And that's what we're seeing right now. All right, let's talk tariffs just for a second. You see, President Trump might have expected China to fold early in the trade negotiations. That was a big smack in the face with those tariffs. But guess what? They didn't. But now both sides have opted for really a cooling off period, right? And with that, we've seen a path of de escalation begin to emerge. Guess what? Markets adapted. And while the fear of long term tariff wars did real short term damage, investors are realizing that the most extreme scenarios, well, they're really unlikely to stick. Now, why is this? So it's because unsustainable economic environments, they just don't last. No one's going to keep up 100% tariffs in place indefinitely between two major economies. It's just not realistic. Even importers seem to sense that. If they believed tariffs were permanent, prices would have surged by now to protect margins. But instead, inflation dropped to a new 4-year low. So where do we sit right now? Well, volatility has definitely calmed down, and the stock market has rebounded toward new highs. And with inflation softening, expectations of near-term Fed rate cuts have eased a little bit, though we still think a cut in the back half of the year is on the table and should probably and likely happen. And why is all this? Well, because intermediate term treasuries, especially in the 2 to 7 year range, they've lowered in yield. And that tells us that the bond market, it's still pricing in a recession risk, or at least signaling that the Fed is too tight for the current environment. And with the second quarter GDP estimates bouncing back to about 2 to 3%, the economy, it's showing resilience. So what's my viewpoint? Well, here's the thing. I'm going to encourage you. Don't panic with the headlines. You got to understand that most corrections are temporary. They're fear driven. And ultimately, they resolve through either more clarity or just adaptation. We saw this again during the earnings season, right? Yes, some companies held back on forward guidance due to tariff uncertainty, but overall results, they were strong enough to bring buyers back into the market. Now, going forward, I think the attention turns back to Washington, or maybe stays in Washington, where the continuation of the tax policy debates, they're heating up. Yeah, the market expects income tax cuts to continue, but the political horse trading, well, it could introduce some different distortions out there. And that's something that we're going to be watching really closely over the next few weeks, next few months as well. Now, I want to hear from you on this. Do you think that this market correction felt different? Whether or not we say it was different or not, how did it feel for you? Or are we just seeing another chapter in the same story and it's kind of like, man, once again, it's the same old, same old, same old. Drop your comments below or shoot me an email at heyhobart@hobartwealth.com. We might feature your perspective in a future episode. And again, as always, thanks for joining me on the Wealthologist Friday Focus. This is one of those moments where I think the quote from Warren Buffett really rings true. And I want you to leave this time with this, which is be fearful when others are greedy and greedy when others are fearful. All right, folks, let's stay smart. Let's stay intentional. And as always, if you want a strategy that's built to adapt like in moments like this, just drop us a line. Let us know. We're always here to help.